Emera Incorporated, the Canadian regulated utility holding company, Tampa Electric in Florida's fastest-growing market, Nova Scotia Power, Peoples Gas, and New Mexico Gas, with a $4 billion annual capital plan.
Adjusted EPS Canadian 137, beating consensus by 24%. Emera Energy record quarter, guidance raised, 5 to 7% EPS CAGR through 2030, reaffirmed.
Emera was incorporated in 1998 as a holding company for Nova Scotia Power, beginning its Florida strategy in 2000 with the acquisition of Tampa Electric Company.
Emera expanded into New Mexico gas distribution in 2016 and completed NYSE dual listing in May 2025, removing TSX friction that had excluded U.S. institutional buyers from the stock.
Scott Balfour became CEO in 2018, executing a capital allocation strategy, concentrating resources in high-growth regulated markets, anchored by Tampa Electric's exposure to Florida load growth.
Florida Electric, Tampa Electric, and Peoples Gas generates 55% of revenue. Canadian Electric, Nova Scotia Power, contributes 26%. Gas utilities and Emera Energy round out the mix.
Tampa Electric's Florida strategy is load growth driven by Hillsborough County's population expansion. Rate base grows from new connections rather than rate increases, generating regulatory goodwill.
Adjusted EPS Canadian 137 versus 120 consensus, a 24% beat. Emera Energy delivered a record quarter, full-year guidance raised.
The Canadian $4 billion annual capital plan deploys into Tampa Electric solar and battery storage, compounding rate base and delivering 5 to 7% EPS CAGR through 2030.
NextEra Energy is the dominant Florida utility competitor. Dominion Energy and Southern Company compete in regulated utility peer comparisons. None has Tampa Electric's specific Hillsborough County load growth exposure.
Hillsborough County's population growth directly translates into load growth for Tampa Electric. Rate base expands from new connections rather than price relief requests, a lower friction growth path.
Emera's $4 billion capital plan earns regulated returns Canadian $2.2 billion in Tampa Electric solar and $410 million in battery storage by 2030.
Tampa Electric serves the Tampa Bay region, one of the fastest-growing MSAs in the United States. Nova Scotia Power serves all of Nova Scotia. New Mexico Gas serves statewide customers.
The NYSE dual listing through direct shares, not ADRs, expanded Emera's shareholder base to U.S. utility-focused funds that track domestic utility indices and could not previously hold the TSX-listed stock.
Scott Balfour has served as president and CEO of Emera since 2018, reaffirming a 5 to 7% EPS CAGR through 2030 and completing the NYSE dual listing in May 2025.
Under Balfour, Emera concentrated capital in Florida's regulated utility market, completed the NYSE dual listing, and raised full-year guidance, compounding regulated utility returns through load growth.
Emera Incorporated, the regulated utility holding company, Tampa Electric serving Florida's fastest-growing market, Q1 2026 adjusted EPS, Canadian 137 beating consensus by 24%, and a $4 billion capital plan deploying into solar and battery storage.
Q1 2026 record quarter at Emera Energy. Guidance raised, 5 to 7% EPS CAGR through 2030 reaffirmed. Emera's regulated Florida utility is compounding through load growth, the infrastructure case for U.S. Sunbelt utility demand.
A Canadian utility just posted a record quarterly earnings number, and the engine behind it isn't in Canada at all, it's in Florida. Emera Incorporated delivered 1.37 Canadian dollars in adjusted earnings per share for Q1 2026, a record high, beating estimates by 14%. The Sunbelt is doing the heavy lifting. I'm Hudson, she's Lana, and this is Charged Alpha.
Emera is a Halifax-based utility holding company with about $16 billion in market cap. The portfolio spans 2 countries. Roughly 60% of the business is in the United States through Tampa Electric and Peoples Gas in Florida, which operate under the TECO Energy umbrella. The remaining 40% is Canadian and Caribbean, Nova Scotia Power being the flagship, along with Emera New Brunswick and several smaller island utilities.
It's a classic regulated utility story. Predictable cash flows, rate case-driven growth, and a dividend that's been climbing for years. Emera pays 2.93 Canadian dollars per share annually, or about 73 cents per quarter. The pitch to investors has always been steady compounding with downside protection. What's new is just how much Florida is accelerating that compounding.
Let's go through Q1. Revenue came in at 2.813 billion Canadian dollars. That's up 5.1% year over year from 2.676 billion in Q1 2025. To put it in US dollar terms, that's roughly 2.05 billion at the current exchange rate. The company had been expected to hit around 2.44 billion Canadian, so this was a meaningful beat on the top line.
And the earnings number is really the headline. Adjusted EPS of 1.37 Canadian dollars. That's a record for any single quarter in Emera's history. Estimates were sitting at 1.20 Canadian dollars, so they cleared by 14%. Adjusted net income landed at 415 million Canadian, up 9.5% from 379 million in Q1 2025.
Now, GAAP reported EPS was actually 1.85 Canadian dollars, which sounds great until you note it was down from 0.96 in Q1 last year. That gap comes from IFRS mark-to-market adjustments and one-time items that get stripped out of the adjusted figure. For a regulated utility, most analysts focus on the adjusted number. It better reflects the underlying rate base earnings power.
There's a currency wrinkle worth flagging. Because Tampa Electric and Peoples Gas earn in US dollars, a stronger Canadian dollar is actually a headwind when those earnings get translated back. Emera absorbed roughly 17 million Canadian dollars of currency drag in the quarter. Despite that, adjusted earnings still hit a record, which means the underlying US operations ran that much better.
The offset on the Canadian side was Nova Scotia Power, which came in below prior year. Nova Scotia operates under a different regulatory construct and faces pressure from rising operating costs and a slower pace of rate-based growth compared to Florida. So the mix shift matters. Florida is growing faster, Nova Scotia is capped by regulation, and currency is a mild headwind. The record quarter happened in spite of all three of those drags.
Scott Balfour has been president and CEO of Emera for nearly a decade. His consistent message has been disciplined capital allocation into regulated rate-based growth, particularly in Florida. He's avoided the speculative merchant energy plays that have tripped up other utility holding companies and kept the dividend growth track record intact.
The analyst community views Emera as a high-quality regulated utility with above-average growth visibility, but the stock's Canadian listing and dual currency complexity keep some U.S.-focused funds on the sidelines. Most coverage sits in the buy or outperform camp, with price targets that imply modest upside from current levels.
The growth thesis is straightforward. Tampa Electric and Peoples Gas serve one of the fastest-growing population corridors in North America. Florida's Sunbelt migration, retirees, remote workers, tech transplants, keeps residential demand growing faster than most U.S. utility service territories. That justifies ongoing rate-based investment, which flows into earnings over a multi-year horizon.
Analysts also point to Emera's 5-year capital plan as a reason to stay constructive. The company has outlined roughly 9 to 10 billion Canadian dollars in capital investment through 2028, with the majority weighted toward the Florida utilities and renewable energy build-out. That capital program is the engine of future rate-based growth, which is what drives regulated utility earnings.
The counterpoint from skeptics is valuation. Emera doesn't come cheap on a price-to-earnings or enterprise value-to-EBITDA basis relative to U.S. peers. The Canadian domicile adds currency risk for USD investors, and some fund mandates simply exclude non-U.S. listed names. Dividend growth, while consistent, has slowed compared to the mid-20-teens pace when the Florida acquisitions were first adding to earnings. So the street is constructive but not euphoric. It's a hold and compound story rather than a re-rating catalyst story.
The bull case centers on Florida's secular demand growth. Tampa and St. Petersburg are absorbing tens of thousands of new residents every year. Peoples Gas serves natural gas distribution in a state that has historically resisted full electrification of heating and cooking, so there's a natural gas growth layer on top of the electric utility story. Rate cases in Florida have historically been constructive, and the regulatory environment is supportive of utility capital investment.
Bulls also point to the record Q1 as evidence that the Florida bet is paying off now, not just in theory. 14% EPS beat, 9.5% adjusted net income growth, a record adjusted earnings figure, all achieved while absorbing a 17 million Canadian dollar currency headwind and weaker Nova Scotia results. If Florida continues at this pace, Emera could consistently outperform its own guidance, which would compress the valuation discount over time.
The bear case starts with Nova Scotia Power. It's a regulated monopoly in a slow-growth province, and it's facing cost pressures that the regulator may not fully allow the company to recover through rates. If Nova Scotia earnings deteriorate further, it creates a drag that Florida has to work harder to offset, and at some point that drag starts to matter for total company earnings growth.
Currency is a persistent risk. If the Canadian dollar strengthens further against the US dollar, which could happen in a commodity cycle, Emera's US earnings translate into fewer Canadian dollars on the income statement. The 17 million headwind in Q1 wasn't catastrophic, but a sustained currency move could materially affect reported earnings.
And then there's the balance sheet. Emera carries meaningful debt load, as most utility holding companies do. Rising interest rates increase refinancing costs and can pressure the coverage ratios that rating agencies watch. If the capital program of 9 to 10 billion Canadian dollars requires debt financing into a higher rate environment, the cost of that capital goes up. That's the hidden bear case that doesn't show up in a single quarter's results, but compounds over a multi-year plan.
In the Canadian utility space, the natural peers are Fortis, Hydro One, and ATCO. Fortis is the closest comparable. It's also a Canadian holding company with significant U.S. utility operations, and it competes for the same institutional capital. Hydro One is a pure-play Ontario-regulated electric utility, more domestically focused. ATCO is more diversified into pipelines, construction, and real estate.
Versus Fortis, Emera typically trades at a slight discount on forward earnings multiples. Fortis has a longer dividend growth streak, nearly 50 consecutive years of increases, which commands a premium from dividend growth investors. Emera's streak is shorter, but the growth rate in recent years has been comparable. The Florida exposure arguably gives Emera a higher quality growth profile than Fortis's more diversified U.S. utility mix.
For investors comparing Emera to U.S. peers like Ameren, Energy, or WEC Energy, the key difference is the Canadian holding structure. You're taking on currency exposure, Canadian securities regulation, and a TSX listing. That complexity is real, and it explains part of the structural valuation discount. But if you believe the Sunbelt utility growth thesis and want exposure via a dividend-focused compounder, Emera is one of the cleaner vehicles in the space.
On the options side, Emera trades on the Toronto Stock Exchange, and its listed options market is thinner than large-cap U.S. utility peers. Implied volatility on EMA options tends to be low, consistent with the regulated utility profile where earnings are highly predictable and surprises are rare. The Q1 beat was positive, but it wasn't the kind of event that would typically cause a volatility spike. For options players, this is a low IV environment.
Insider activity at Emera is worth monitoring. In a regulated utility, insiders rarely have material, non-public information that would create asymmetric trading opportunities the way you'd see at a biotech or a cyclical. Executive compensation is tied to regulated earnings metrics and ESG targets. That said, meaningful open market purchases by directors or the CEO tend to be a signal worth noting. It's one of the few signals that penetrate the predictability noise.
Institutional ownership is the real story in Emera's capital structure. Large Canadian pension funds, the major ones you'd recognize, hold significant positions. Canadian life insurers and income-focused mutual funds are also natural holders. U.S. institutional interest exists but is smaller, partially because U.S.-listed utility ETFs don't include TSX stocks. Any increase in U.S. institutional appetite, perhaps via a cross-listing catalyst or a major index inclusion event, could be a re-rating trigger that the bears don't fully price in.
Emera delivered a record quarter driven by Florida utility growth. The beat was real, the currency headwind was absorbed, and the dividend keeps compounding. This is a steady compounder utility that's doing exactly what it said it would do.
The Nova Scotia drag and currency exposure are real risks, but the Sunbelt tailwind is winning the tug of war right now. For investors who want regulated utility yield with above-average growth, Emera earns a close look, especially on any broad utility sector pullback. Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street